Why does a decision that is made all the way across the world in Japan affect the whole global markets? Today we talk about the Japan carry trade, how Japan has created the cheapest money in the world and how that affects global trade. The Japan carry trade is simply borrowing money from Japan at near zero interest rates, converting it into dollars, and investing it in higher return assets like the US stock market, bonds, precious metals, or Bitcoin. You profit from the difference of borrowing cheap money and getting the returns from higher yielding assets. For decades, Japan was the cheapest source of money in the world. Hedge funds, pension funds, investors borrowed trillions of dollars of yen to deploy in global markets. This worked because Japan has a policy of keeping interest rates low over defending their currency. The Bank of Japan promised to keep bond yields at a certain level by buying as many bonds as possible. The trade-off, however, is a weaker yen that has been declining for decades. The problem is this only works if Japan's rates stay low and the yen stays weak. But now we see Japan's bond yields going up at rates we've never seen before. When these bond yields rise, it causes the carry trade to become way more risky, which then causes investors to unwind their positions, which could look like this. Step 1, you sell your assets, your stocks, your bonds, your Bitcoin, your precious metals. Step 2, convert dollars back into yen. Step 3, repay your Japanese loans. This creates a cascade of actions, people selling off their risk assets, causes a lot of volatility as we've seen for Bitcoin and the stock market. Bitcoin gets hit first and the hardest because it is the most liquid asset, being able to be traded 24 hours. That's why when there's stress in the Japanese bond markets, Bitcoin reacts first. But this is not just a Bitcoin problem. It's an everything problem. That's why, although it seems strange that Japan has such a big influence on the global world market, it makes sense when you follow where the money is.